Well, good morning, Steve. Yes, the numbers on Friday. I mean, I like the numbers, the wage numbers, but for a different reason. I mean, I know you're speaking about the fact that wages are going up by less than prices, and that means that real incomes should have downward pressure from decaying real wages, and that is one consideration of the numbers. But seen through a different lens, I look at the 4.6% increase in wages that were reported, and I look at forecasts or current 6%, 7% increases in CPI, and I say to myself, how can we forecast continued increases of prices at this pace with wage increases as low as they are? And I just can't get there from here. So we're coming out at High Frequency Economics on the bullish side of the inflation outlook, looking for less inflation than the Fed and the market, and expecting that expectations for accelerating inflation are going to be disappointed.
Yeah, but those who have been very, very wrong about inflation, and I would like to say this channel has had a very wide spread of opinions, should we put it that way? But those who have been wrong are now saying, oh, but it's going to come down aggressively. Well, even if it comes down, Carl, it's still going to remain above that 2% level, which is actually the target. We seem to have lost touch with the fact that we are around about 5 percentage points above where the target is. I appreciate that inflation might not run as hot as 7%, as we're going to see later on this week, for long, but it's still going to be above target, isn't it?
Well, you know the old story, Steve. Past performance is no guarantee of future results. We've seen some specific supply constraints in specific sectors that have been pushing up that headline and core CPI numbers. The cars come immediately to mind, with the chip shortage reducing the supply of both new and used cars to the market. We've seen energy prices in the headline number, which have been generating these very extraordinarily high headline figures. These are all going to work out of the maths, and what was a doubling of oil prices as recently as October is going to reduce to a 25% year-over-year increase in oil prices by the time we get to February, March, and go away altogether by the end of the year, unless oil prices double again, which is not our forecast at High Frequency Economics. So I think we can understand where we are, and understanding where we are, we can see that things are not going to continue as they have been in the past, so we shouldn't expect these special factors pushing up prices to continue.
But Carl, I think as we all understand here, the question is not so much what we feel about this, it's how the Federal Reserve Committee thinks about the employment conditions at this stage. And I do wonder, will the Fed be more focused on the 3.9% number and argue that that represents full employment instead of maybe getting hung up on the sluggish payrolls number?
Well, Jeff, I think you're absolutely right. Right now, the Fed is very focused on inflation. It's very focused on responding to the numbers that are being printed. So I agree with what both you and Steve are saying, that the numbers have the Fed's attention. And yes, we do expect the Fed to react to those numbers in the near term. We're expecting that they will hike rates in May and then again in June. But as they are hiking rates, we expect to see both the inflation numbers and the growth numbers for the economy deteriorate. And as they deteriorate, the impetus for the third, and now people are talking about a fourth hike in rates later in the year, I don't think the pressure is going to be there by the time we get to that point. So that means for markets that we're probably going to see the yield curve steepen in the very short term and rise in the very short term, but that movement in the yield curve is going to very, very quickly as the year progresses fade away, and that the curve will flatten out and bond yields will retrace as inflation doesn't deliver the expected result, and as the Fed backs away from the third and the fourth rate hike that people are talking about right now.